responses I might want to make after that shock arrives. So we're basically going to claim in this paper that using firms' 10K risk factors, which I'm going to spend some time talking about as we go through the talk, is going to allow us to address both problems. Okay, so let me go through a basic argument, and if you buy this argument, I think you'll, by and large, understand the paper. So here's the empirical strategy that we have in mind. So as I'll describe in a little bit more detail, these 10K risk factors call on firms to articulate all sources of downside earnings risk, right? So I'm a firm. I write down maybe in 5 or 10 pages all the things that I think might happen that cause me to suffer negative earnings surprises in the future, right? Then a shock arrives, right, after I've written all these risks down. And what's going to be the effect of the arrival of this macro shock? Well, some of these risks are going to be realized, right? So some of the things that I wrote down in this document actually end up happening when a shock arrives. While other of these risks might become less salient, right? Things that I thought might happen to me are now less likely to happen to me after this shock arrived. The shift in all these firm level risks is presumably going to change market beliefs about future earnings, because these risks were written down specifically as a function of firms' beliefs about future earnings. So if macro news arrives that shifts the probability distribution over those risks, that's going to shift beliefs about future earnings. And so the firm's stock price move in reaction to this channel of a shifting probability distribution over these risks is going to be linked to fundamentals, right? Rather than other non-fundamental phenomena that might drive asset prices. So this implies that 10K language can help us isolate the fundamental component of a price change. And also, because we're going to get the full text of these things, tell me something about the drivers of those changes. All right, so both problems that I've referred to, which is extracting the fundamental component and interpreting what drives individual price moves, are going to be addressed by this empirical strategy. All right, so this is meant to be a kind of general idea that could be applied to whatever macroeconomic shock you're interested in. And in fact, Christian and Steve and I started working on this in the context of monetary policy shocks, but then in the intervening period, COVID happened. All right, so we decided to write this first paper about the COVID shock. And why did we do that? Well, as this figure illustrates, as I'm about to explain, COVID was associated with both large aggregate effects, sort of, historically large when we think about the period since World War II, but also a lot of firm level dispersion. So let me explain what this figure is. So on the horizontal axis, we're measuring the aggregate change in U.S. equities for a sample of about 2,500 firms. Right? So the gray dots in this picture refer to 2019 trading days. So in 2019, there was some particular day. So Luciano, I still see your video on. Can you see this little hand that I'm using to hover over dots or not? Perfect. So if you look at this, this date in 2019, this says that, on that particular day, US equities fell by like 2%, okay? But for most 2019 trading days, we see that there weren't like big aggregate market moves. Now contrast that to a 20-day period in 2020, where there were about, I think, 20 separate dates in February and March 2020, in which we had aggregate market moves of 2% or more. Right? So this chart is basically making the point that in early 2020, we had like massive aggregate market moves. And what were the sources of those market moves? Well, these color codings are from another paper by Steve Davis and Nick Bloom and Scott Baker, in which they take next day newspaper articles and read them and use the content of those newspaper articles to label dates in terms of what drove these large equity price movements in aggregate. So for this talk, I'm mainly going to be focused on these red dots. All right, so on these 9 separate dates, there were both large negative market moves, and journalists attributed those market moves to news about COVID, this economic fallout of the COVID. And then the other dates on this chart reflect policy responses and non-COVID related events. All right. So it's probably no surprise to you that the pandemic was expected to be bad in aggregate, and that's basically what this says. More interesting for the purposes of this paper is the vertical axis. So the vertical axis measures the spread in the cross-section of firm equity returns. So I should say these are abnormal returns, not just raw equity returns. So if we take a date like March 16th or March 18th, the interquartile range of the cross-section of abnormal returns was something like 16 standard deviations above the same distribution for 2019 trading dates. So these are massive outliers, not just in terms of the aggregate move, but also in terms of the cross-sectional dispersion that we see at the firm level. And that's really what this paper is about, right? So what characterizes the cross-section of abnormal returns when we get the arrival of these large shocks? All right. Now, you might tell me.
Sorry, one clarification question. Should we interpret the vertical axis as the variance of the returns in the cross section?
So you could do a similar chart for the standard deviation. We did the IQR just to make sure that the outliers weren't driving this chart. But if you were to do this for standard deviation, it would basically look exactly the same. Okay. All right, so you might tell me that, we know that there was heterogeneous kind of firm level exposure to these macro shocks. If you were in airline industry or if you were in the travel industry, you were going to do badly, right? Because we could already anticipate that COVID was going to shut you down for the next year. And if you were like, online retailer like Amazon, you were going to do well. All right, so that's an argument that basically the sector that you work in and operate in is the driver of your exposure to this macro shock. So here's an example to kind of show you that that's not true, at least in some specific cases. And then we can see more broadly how this message holds in the full sample. So here's a couple of firms. One is called NetApp Inc. Another is called Scientific Games. Both of these firms operate in the same 4-digit NAICS sector. So this is computer and peripheral equipment manufacturing. But if you look at their abnormal returns, or their average abnormal returns across those 9 red dots that I just showed you, you see that NetApp Inc. has a positive abnormal return, Scientific Games has a negative abnormal return. And those kind of map into also a big gap in revenue growth subsequent to the arrival of this macro shock. Now, it turns out that NetApp Inc. is a cloud computing provider to various firms, including those in the pharmaceutical industry and the telecommunications industry and whatnot. Scientific Games is also a cloud computing provider, but it's specialized in providing cloud services to large casinos. So before I wrote this paper, I didn't realize that when you go to Las Vegas and play slot machines, or you go to the poker table, there's some cloud system that's running the automatic card shuffling system at the poker table and also running the slot machines. And Scientific Games, I think, is the big player in this industry. Right? Obviously, they're going to have different exposures to the pandemic shock because of who their customer base is. Now we can go down into even more narrow industries. So these are 6-digit NAICS industries, right? Full service restaurants. So again, we see between Domino's Pizza and something called Ruth's Hospitality Group, there's about a 9 or 10 percentage point difference in abnormal returns. And again, about a 60, 70% gap in real outcomes following the shock. Right? So what's the message of these examples? Well, first, there appears to be this link between abnormal returns on these particular shock dates and later real outcomes. So this is the kind of natural correlation that people expect when you're using equity returns to measure firm level exposures. But there's also a sense in which sector membership is a very kind of imperfect proxy for your exposure to this macro shock. And your firm-specific exposure to the macro shock is linked to pre-pandemic business practices, right? So Domino's Pizza had already set up to do home delivery of pizzas prior to the arrival of the pandemic. Ruth's hospitality group runs steakhouses. Most people don't want to order a steak at home, right? You want to go out to a restaurant to order a steak. But the point is, all of these firms invested in certain technologies or customer bases or business practices before the arrival of the shock. And then when the shock hit, those business practices created positive and negative outcomes for them. All right. And that cannot be captured by their sector fixed effects or their firm size or the other traditional controls in an asset price regression. You really need to somehow measure those specific things. And we argue that text is a very natural way of doing that. Okay. All right. So what are our specific contributions? Yep.
Sorry, I was thinking about this idea of measuring the pre-pandemic exposures through the business practices. But since the states and counties were differentially exposed to COVID, maybe you could also use the geographical exposure from these companies to different states and counties, right?
Yeah, okay, that's a good point. Yeah, so one thing I should say is that by the time we end up matching all of these firms across different databases from which we draw different data, I think we end up with about 1,500 firms. And so those are kind of the large publicly traded firms in the US for which geographic variation is probably less relevant, but that's a point well taken. So thank you. All right, so the first thing we're going to do is build a pandemic exposure. So we're going to start from these firm level abnormal returns, but then we're going to isolate the part of those abnormal returns that 10K language can explain. And that's basically going to be this, this sort of text-based pandemic exposure. And we're going to see that if you want to explain the abnormal returns in this graph here, you're going to get quite a large increase in explanatory power by conditioning on firms' language. Above and beyond the standard controls you would put in an asset price regression. But all of that is just sort of preliminaries. The main thing we're trying to do is then take this text-based exposure and see what impact that has on the real economy and what channels is driving that real impact, right? So if I may say so, I don't particularly like to make bold claims, especially when it's not a working paper yet, but at least I was surprised by what I find to be two remarkable properties of this text-based exposure. So when I show you the statistical model that generates this text-based exposure, I think it's completely non-obvious, these two things I'm about to tell you. Well, first, the entire effect of raw abnormal returns on future real outcomes is captured by this text-based pandemic exposure. So once you control for this text-based pandemic exposure in a standard kind of real outcomes regression, whatever's left over in abnormal returns has no explanatory power. So it appears like you've not just captured some of the fundamental variation in abnormal returns, you've captured all of it, okay? Which wasn't our goal, but at least in this particular application seems to be true. Moreover, all of the explanatory power in these real outcomes regressions from our text-based exposure can be represented in terms of interpretable word groups. So this isn't going to be some like black box machine learning object where nobody knows what it is and nobody knows what it does. We're actually going to be able to isolate the specific language that goes into this text-based exposure and show you that the entire impact of this text-based exposure on the real economy comes from about 30 word groups. And those 30 word groups are all highly interpretable, all right? Which then let us explore the particular channels that we think made the pandemic generate different firm level outcomes in the real economy. All right, so what are our empirical findings? Well, we find that basically we can quantify what the impact of pandemic exposure was on real outcomes of various sorts. Revenue growth is our main outcome variable. So one standard deviation change in our exposure shifts predicted 2-year revenue growth by about 18 percentage points on impact. So in 2020 Q2, the quarter following this macro shock. And then there's like a very persistent but declining effect. All right. So over the next 2 years, you continue to see pandemic exposure generating significant differences in revenue growth, but by about 2 years, that impact is sort of gone. Okay, and so that gives you a quantification of how these differential firm-based exposures generated sort of different firm outcomes. And then when you dig into the particular channels, you find things like air travel, consumer spending, IT services, and intellectual property as sort of the key drivers. So let me say right now that the point of the paper, when I say air travel exposure was an important driver of firm level outcomes, I don't mean that being in the airline industry was an important driver of firm level outcomes. What I mean is any exposure to air travel was important. That could come from being an airline, but it could also come from being an input supplier to an airline. It could come from running a website where you sell airline tickets and so on and so on. And so the last thing we're going to show is that these specific exposures are really distributed quite widely in the economy. So I'm not talking about sectors here, I'm talking about exposures, and exposures cut across sectors quite a bit. Okay. So that's sort of the introduction. I'm not sure whether there's any more questions, but otherwise I'm gonna carry right on. So
I have one, hopefully quick.
Okay.
I am Ernesto Pastor from the bank. When people study high frequency identification for monetary policy shocks, typically people make a big deal between the actual effect of the shock versus the information that shock may contain and may have some effect. Is this distinction something that you care about? And if so, the text methodology allow you to disentangle current effects of the shocks versus prospective effects of the shocks, let's say?
Yeah, so we do need to return to this monetary policy thing eventually. So if I can stay in that context to better understand the question. So we have this, this argument in the literature that a monetary policy shock as measured by asset price changes might come from a true monetary surprise where I just came in and like raised interest rates kind of randomly. Or it could come from some information that the central bank has made available through its policy action, which then itself drives the change in asset prices. Is that the sort of distinction you have in mind?
Yes. So the karate thing.
Exactly. So yeah, so I think the analogy would be this, right? So in the Karate Yarojinsky paper, they sort of have their monetary policy shock on one side, and then they have their equity price, exposure on the other side. And as I remember, they sort of use the signs of these things to measure which of these two effects is the most important. But yeah, so I guess what we're saying is that if you take the equity price movements by themselves and look at what language is driving them at the firm level, I guess the hypothesis would be that there are certain words, and I'm kind of thinking off the top of my head, but there's certain words that we think would be associated with the information effect, like demand. Like these risk factor sections are filled with language about the demand for my products. Then there's other language
it could be current demand, it could be prospective demand. So yeah, that's why I'm asking.
Yeah, so all of these risk factors are sort of forward-looking. So they're about what's going to happen to my demand in the future. But then I was also going to say there's language about your sort of financial structure. So how much debt do you carry? How many liabilities do you have? And in fact, these risk factors are actually separated out into kind of business practices, financial structure, and whatever. And there may be some leverage you could get there. Like which of those two things most explains these firm level equity price moves?
Another thing is that it has nothing to do with this paper, but since you're interested in the monetary policy application, there is a new paper by Eric Swanson that criticized the high frequency identification strategy and actually proposed a fix using text. So I'm going to paste the link in the chat.
That would be great. Thank you. I know that he has a paper criticizing the Fed information effect, but I'm not aware of the use of text. So thanks. It'd be great. It'd be great to look at that. I think in this particular paper, the COVID shock is a little bit less well understood theoretically, right? So all I know is that like a pandemic has arrived, and many things are potentially happening, right? There could be network effects, there could be effects from selling complementary or substitutable goods or whatever. Okay, so we're basically, I guess, doing a more of an empirical characterization of what's driving these firm level outcomes. And then I think that would be useful for informing kind of theories about this going forward. All right. So let me, sorry, is there one more question here? Okay, Carlos. So basically, I am finding that investors use available information, and that information explains abnormal returns around those dates. That's right. So I'm going to show you the asset price regressions. And it is true that these risk factors explain asset prices, but there's a lot of asset prices that are unexplained in an asset price model, right? And I think the remarkable thing is not that these risk factors explain asset prices, because as you imply, Carlos, it sort of makes sense that investors use risk factors to inform their beliefs about the way that shocks are going to impact future earnings. I think what I didn't expect is that what risk factors don't explain have no effect on future real outcomes. That's a much stronger statement, right? So anything that seems to be correlated with future real outcomes at the firm level is encompassed by the empirical correlation between abnormal returns and risk factors. Whether that fact is true more generally, I don't know, but it's true about COVID-19. All right, so in finance, these risk factors have been used for, you know, at least 10 or 15 years, okay? I think they're less familiar in empirical macro. So at the risk of boring some of you, I'll spend 1 minute describing what they are. So every year, firms that are publicly traded in the US have to submit to the Securities and Exchange Commission what's called a 10K regulatory filing. And these contain different sections, one of which is the risk factors section. And in the risk factors section, firms articulate sources of downside earnings risk going forward, as I've already said. Now, one of the reasons that these are exhaustive documents is that they have some legal force, insofar as if something happens that negatively affects your earnings that you could have plausibly anticipated as a firm, but did not write down specifically in your 10K filing, then investors can sue you and take you to some arbitration panel for compensation, all right? So there's a strong incentive for firms to sort of, you know, hire lawyers and make these things sort of airtight in terms of avoiding liability. And for that reason, they're really quite extensive and they articulate all kinds of things. Even things you may not realize that firms think about are in there. So the sample of these risk factors discussions that we're taking are for 2,500 companies. We in fact have them for about 8,000 companies, but we're using the sample because we can match it to the abnormal returns data that I'll tell you about later. And we're only taking these from the pre-pandemic period. So this is not going to be some now casting exercise or anything like that. So all of our text is coming from before the world knew that COVID would happen. And for those of you who came to the course last fall, this will be familiar, but for those of you who didn't, let me just briefly explain that the most standard way of representing text as data is through something called the bag of words model, in which a document is converted to a histogram count over a bunch of terms, all right? And then we're basically looking at firm level observations of long histograms, right? So those histograms are 16,000 dimensional. That's the number of unique terms that show up in this corpus. And the main challenge in working with text data is this vast dimensionality, all right? So we're basically left with a document term matrix with about 2,500 rows and 16,000 columns, all right? Where an element of the matrix is how many times a particular term shows up in a particular firm's 10K filings. Okay, so in addition to those 10Ks, we have the abnormal return, or rather the average abnormal return on these pandemic fallout dates. and then standard controls that you would put into an asset price regression. So we have leverage, market capitalization, the sector that you operate in, and then our numeric data is the abnormal return that you generated when this news arrived, and this vector of numeric controls. Right now, I want to put these together, right? I want to do like a text-based asset price model. So the most straightforward thing to do would be to run a regression of the form, I want to predict abnormal returns, conditional on your 10K language and the other standard controls in an asset price model. We're not going to do that, all right? We're instead going to model what's called an inverse regression. So we're going to model the terms themselves, right? So that's a 16,000 dimensional vector. I want to model variation in that 16,000 dimensional term count vector as a function of your realized abnormal return on these 9 pandemic fallout dates and the numeric controls. Now, why are we doing this? One is it's just kind of a richer language model where we can link language directly to covariates. I think the more important explanation is about dimensionality reduction, right? So if you come to this perhaps more natural seeming model, how would you estimate it? Well, you're not going to do something like OLS or anything like that. So you could imagine some kind of penalized linear regression model using lasso or ridge regression or whatever. But those procedures sort of tend not to work particularly well when you have a strong correlation structure in your high dimensional set of covariates. So most text regression models engage in some kind of dimensionality reduction. So that could be through PCA or topic modeling or whatever, all right? One of the advantages of an inverse regression is that you can do what's called model-based dimension reduction, in which I can present to you a particular scalar value that encompasses all of the relevant information in this text vector for explaining the outcome of interest. So I'll formalize that statement in a little bit, but basically we can think about inverse regression as allowing us to do dimensionality, some kind of like supervised dimensionality reduction rather than unsupervised dimensionality reduction.
Yeah, just one question to understand the, let's say, the vanilla regression, the OLS regression.
Yeah.
The dependent variable is the abnormal returns after the pandemic, and a condition on the list of words that
So
the risk that firm had in advance before the pandemic.
Yeah, so that's a good question. Thanks. So the abnormal return. So each one of these red dots represents a trading day in 2020, right? And on each one of those trading days, I see 2,500 firm level abnormal returns. So the dependent variable in that OLS model would be the average across those 9 dates at the firm level. The explanatory variables would be the words that I used in my 10K filings before these dates. Okay. All right, I see one more question from Carlos. Is this inverse regression performed on a different data set than the final regressions? I think what you mean, Carlos, is we should do kind of out-of-sample analysis. And I'm about to show you in-sample and out-of-sample analysis. But I'm going to start with constructing this text-based pandemic exposure in-sample, and then we'll see how it performs out-of-sample in a minute, all right? By the way, I'm going to pay attention a little bit to time. So it's 10 past 5 in London, more or less. What time should I be stopping? In about 45 minutes or something, about 10 to 6, Luciano, is that right? Something like that, okay. So there's various ways of doing inverse regression. We're actually gonna kind of take a very simple model proposed by Matt Taddy in the Annals of Applied Statistics in 2015 and recently used by Ginskow, Shapiro, and Taddy in an econometrica paper for measuring political polarization.
Steven?
Yep.
Sorry, just before you go to the details of the methodology. First, you have 50 minutes.
So I can go through to 6 p.m.
Yes, it's okay. Depends on. And, and second, regarding this vanilla regression, so just to understand the logic, so the part that is unexplained by the words that contain information about risk is what you're going to attribute to COVID?
No. So in fact, the opposite. So what I can explain with the words, I'm going to call my text-based pandemic exposure. And why am I going to call it that? Because anything that I can explain systematically, I have to return to Carlos' point about the out of sample analysis, and we have to worry about overfitting. But just the general idea is that these words written in 2019 are telling the market things that might happen in the future to these firms. So demand might fall for my product. The technology I use may become obsolete. You know, whatever. My suppliers may go bankrupt, which prevents me from producing output. Okay? All of those things are written down in these documents. Now COVID arrives. That sort of shifts the market beliefs about the events that were anticipated in 2019. Right? So if I wrote down in 2019 that demand for my product might fall in the future, and then COVID happens, and I'm in the airline industry, then demand for my product is anticipated to fall, right? The arrival of that shock sort of changes market beliefs about whether these things will or won't happen that firms wrote down. And so the correlation between what I wrote down might happen to me and the shocks shifting of the probability distribution of those things happening is going to shift market expectations of future earnings. That's the idea. And then I have to make sure that I'm kind of not overfitting, right? Because I'm always going to find some correlation between high dimensional vectors and outcomes, right? So I need to do something to control that. So that's
what you're saying is like how the COVID shock, the Sagre shock, translate into an increase in the probability of this previous risk?
Yeah. So we haven't I haven't sat down and kind of formalized the underlying sort of belief process that motivates this. It's a little bit more heuristic. It might actually be useful to sit down and write down this thing at some point. But that's basically the idea. That the correlation.
Maybe firms wrote this risk, and because they were thinking that there is a high probability that this risk, these things, or these kind of risk could actually appear in the future, independently of COVID. So
yeah, so all of the kind of identification here is going to be within sector, right? So anything that explains sort of sector level effects is going to be encompassed by these sector fixed effects. So at the very least, this isn't going to be some kind of generic thing that all airlines write down or some generic thing that all online retailers write down. The only correlations I'm going to pick up between language and abnormal returns are going to be happening within sector. And so it's not going to be these sort of generic things that everybody writes down. Because if they all wrote it down, that would be swept out by this sector fixed effect. Okay. All right. So I don't want to disappoint you, Luciano, but we're not actually going to go through the details of the model. If you want to, I can go to another set of slides, but I'm basically just going to show you the model and then write down the key properties so that we don't spend 20 minutes talking about statistics. Although I do find it interesting, so if anyone wants to ask, that's great. So you can basically think about this as an enormous discrete choice model. Right? I'm assuming that these 16,000 dimensional term count vectors at the firm level are drawn from a multinomial distribution with a firm-specific probability, multinomial probability vector, which is generated by this logistic function, basically, or multinomial logistic function. And that's going to be parameterized by linear combination of the numeric data and a set of regression coefficients. All right, so pretty standard for any of you who've estimated a discrete choice model. The only difference being there are 17,000 choices being made now rather than 5. All right, so two properties about this model. And this is all I'm going to write down. Okay, so if anyone wants to ask anything else, then we're going to have to do something else. So Taddy's Annals of Applied Statistics paper shows you how you can estimate this model efficiently. Okay, so if you want to estimate a super high dimensional discrete choice model with maximum likelihood, it's going to be difficult. But under quote unquote reasonable assumptions, we can approximate the likelihood well by estimating these separate Poisson regression models. So basically, for every term in the 10Ks, I'm going to have a separate Poisson model, and I'm going to estimate that Poisson model across all firms as a function of these numeric vectors. All right, so we're kind of breaking the dependence between all of the choices, right? So in the multinomial model, you have some dependence, like when you become more likely to choose category I, you're less likely to choose category J, and that makes it a nightmare to compute. The Poisson model basically imposes some kind of independence across these choices. That's just a computational trick. The deeper point, and the point related to dimensionality reduction, is this second point, which is a much more general property of inverse regression models, but this is its articulation in this particular environment. So I can define what's called a sufficient reduction projection. And the sufficient reduction projection is a linear combination of the counts that a particular firm generates in its 10Ks and the estimated Poisson regression coefficients from all of the V Poisson models that just got estimated. All right, so that's a scalar value, which linearly combines term counts with estimated regression coefficients. Right? So from this point on, I'm going to isolate the sufficient reduction projection for the abnormal return. So each one of these Poisson regression models contains an estimated coefficient for the abnormal return. Right, it's marginal correlation with the term count, controlling for all the other standard controls. And that object, that sufficient reduction projection for the abnormal return, has the following property. So abnormal returns are uncorrelated with this high dimensional count vector, conditional on the sufficient reduction projection and the other numeric variables. So this means it's basically like a sufficient statistics type result, that I can collapse all of the information in the 16,000 dimensional vector into a single number. And once I condition on that single number, there's no incremental information left from the original high dimensional vector for predicting abnormal returns, which means that I can take this scalar value and use it to summarize all the information in the kind of messy high dimensional object. There's a little bit of a proof of that, but I'll never get to the end of the slides if we don't, if we go through them.
Stephen,
Yeah.
But like for PCA, there must be some kind of way of testing whether you are getting enough factors from this, right? Whether you need 2 components in the vector or 3 components.
So this isn't really PCA, right? So this is just saying that every variable in the discrete choice model, so every variable inside this, this set of covariates that I'm feeding through the discrete choice model has a scalar representation that summarizes all of the information that the text data contains that's relevant for its prediction. That's it. I think I've never actually studied something called independent components analysis, but I think that there's an analogy between PCA and ICA that's related to this discussion. So ICA kind of makes sure your components are rotated in a way that's best for explaining some outcome variable. And this has a flavor of that, right? So you're doing dimensionality reduction, but in a way that's informative for a particular outcome variable that you care about predicting, okay? All right, I see one more question from Carlos. Does your model allow for different effect for positive returns versus negative? returns for the same word? No. Okay, so every word is given a single coefficient, right? All right, so this is the output from the Poisson regression models, right? So it turns out that the first thing that's done to control overfitting is to fit these Poisson models with the lasso penalty. All right, so there are roughly 3,000-4,000 terms that don't have a systematic correlation with abnormal returns that's strong enough to overcome the lasso penalty. But there's plenty of terms, both on the positive and the negative side, that do seem to associate with abnormal returns. And here's just a small sample of the terms that are associated with negative abnormal returns, in the sense they have a negative regression coefficient, and terms that have a positive regression coefficient. Right? I don't really want to linger over this, except to say that these correlations sort of look reasonable. All right, so airlines, hotels, the oil industry are sort of associated with negative returns. Health insurance, vaccines, funnily enough, alcohol. I know quite a few people drank more during lockdown. So, the point is all of this sort of looks natural. All right, and then from those estimated Poisson regression coefficients, I can formulate the text-based exposure, this ZI object, which is going to linearly combine all of those estimated Poisson regression coefficients with the firm level counts of terms. And then I can run this abnormal returns model. All right, so I want to explain abnormal returns as a function of sector fixed effects, the text-based exposure, leverage, and market capitalization. Okay. So here's the first model. Okay, and so Carlos, this is all in sample. So if you're concerned that there may be some overfitting here, then the overfitting is going to show up here, because the Z's have been estimated on the same sample that we're now doing the prediction for. But nevertheless, I think it's still informative. So the first column includes no firm fixed effects, right? So just the firm financials. The second column puts in firm fixed effects. So you see the R squared of this model goes from about 0.08 to 0.27. So clearly being an airline or being in the oil industry matters for market expectations of future earnings. But when you put in the Z-score, you get another 20% of R squared. All right, so at least in sample, it looks like this text-based exposure is adding quite a lot of explanatory power to the cross-section of abnormal returns. Some people have told us that what we're picking up through this text-based exposure is basically what people make. All right. There is some work in finance by Hoberg and Phillips that have used a different part of the 10Ks called product descriptions to build industry classifications. All right, so you can actually take the Hoberg and Phillips industry fixed effects as measured by 10K product descriptions and control for them rather than NAICS2. And you basically see there's no change in the impact of our Z-score on abnormal returns. All right, so it seems like we're picking up something beyond just 10K text describes what firms make, right?
And these are sectoral fixed effects. No? This is a cross section or a panel?
Yeah. So this is the cross section of abnormal returns on those 9 pandemic fallout dates. Yeah. Okay. Now starts the out of sample analysis. So we claim that this Z-score is a pandemic exposure. All right, so when news about the pandemic arrives, this Z-score should be informative about the cross-section of abnormal returns insofar as it's related to systematic shifts in market expectations of the realization of these risks as they relate to pandemics. So we can take different dates, not the 9 red dots I showed you, but different dates in which pandemic news arrived. So the first was the announcement that a vaccine had been developed. So on the 9th of November 2020, news arrived that an effective vaccine had been developed. They published the first field trials of the Pfizer vaccine, and that increased equity returns, right? So I can do the same exercise where I start with no fixed effects, add sector fixed effects, and then add my Z-score. It's certainly true that when I add the Z-score now, the increase in the R squared is not as dramatic as it was in the original sample, but you still see a highly significant and not trivial increase in R squared from including this z-score. So this is pure out of sample, right? Here's another example when Omicron was announced. So in late 2021, this is 2 years, nearly 2 years after the z-score was constructed in early 2020, we still see that the z-score contains significant association with the cross-section of abnormal returns on the dates that Omicron news arrived. Okay. We've done a more formal out-of-sample analysis along the lines of the machine learning literature, where we take the original cross-section of firms on these 9 pandemic fallout dates and split the firms into 10 groups, estimate the model on 9 of the 10 groups, fit the model out of sample on the 10th group, and then compare the out of sample prediction for the abnormal return against the realized abnormal return. The average out of sample R-squared across all 10 test sets is 0.37. Okay, so that compares to 0.47 in the inline model. Okay, so Carlos, just to come back to the point, my interpretation is that there is some overfitting going on in this particular regression right here, but it's not pure overfitting, right? Because otherwise we wouldn't get these associations with later news shocks, and we wouldn't get this out of sample stuff. But to some extent, all of this is a little bit of a sideshow, because what I really want to do with this is not publish a finance paper. I want to take this Z exposure and use it to understand how COVID impacted the real economy. So the rest of the paper is basically devoted to that. Let me just check the time. All right. So I have this Z object now, which I've argued should contain some of the fundamental drivers of abnormal returns on these pandemic fallout dates, right? So what I basically want to do now is take the z-score, take the rest of the abnormal return not explained by the z-score, and use them in a real outcomes regression. All right, so just to be clear, I have this zi, which got constructed from the model above. And now I'm going to take the abnormal return and subtract off the part of the z-score that explained its variation in the asset price model, and that's going to leave me, everything else that the z-score didn't explain. And I'm going to see how these two objects correlate with future real outcomes. So what real outcomes are we going to use? Well, I'm going to take at least the first real outcome is quarterly revenue growth. So we go to CompuStat, and this now, Luciano, to come back to your last question, is a panel setting. All right, so the z-score is constructed from the cross-section of abnormal returns on the arrival of a shock date. And then we're going to plug that z-score into a panel of firm-level real outcomes. All right, so the first panel is basically quarterly revenue growth measured in log points. Right. All right, so the panel regression model that we're running is the change in firm-level revenue in quarter T, right? And so one detail from the previous slide, the change is with respect to 8 quarters previous. All right, so this panel runs through 2021 Q4. So the reason we're doing 8-quarter differences is because every post-COVID quarter is going to be compared to a pre-COVID quarter, right? So if I go to 2021 Q4, I'm going to be measuring revenue growth from 2019 Q4 to 2021 Q4. And in 2019 Q4, there was no COVID. All right, so every quarterly growth observation that I'm going to show you compares a sort of post-COVID with a pre-COVID period. All right, so I'm going to regress the evolution of revenue on sector fixed effects, time fixed effects, a baseline impact of firm level exposures in 2018 and 2019, right? Because I might think that there's some variation in this Z thing that's actually correlated with pre-pandemic revenue growth. And then the coefficients of interest are going to be the interaction of the time fixed effects in these firm level exposures. So from 2019 through 2021, was it the case that I had a change in the association between my firm level exposure and real outcomes? above and beyond whatever the baseline association was in 2018 and 2019. Then I'm going to continue to control for these firm level controls of size and leverage. And we're clustering standard errors by sector and quarter.
Sure. So now, Steven, how do you read this equation? Is like this gamma t gonna capture the COVID shock in 2020?
No, so
the gamma t in the
yeah. So if if ZI is capturing pandemic exposure, and pandemic exposure generated real effects after the pandemic arrived, that's going to be captured in these estimated gamma coefficients. Above and beyond whatever association existed in 2018 and 2019. So it may be the case that being exposed to the pandemic was correlated with having higher or lower revenue growth in 2018 and 2019. Right? Cloud computing services might have just been generically growing. What the gamma T is going to tell you is, did pandemic exposure shift your revenue growth relative to the baseline before COVID? Okay. And here are the results. So the left-hand panel shows the estimated gamma T coefficients on the ZI, this text-based exposure. And the right-hand panel shows the estimated coefficients on everything in the abnormal return that was not explained by ZI. Right, so this again is an out-of-sample thing, right? So the ZI was not constructed to explain real outcomes. It was constructed to explain the cross-section of abnormal returns when pandemic news arrived. But when you look at the left-hand panel A, it very much looks like the ZI thing is capturing the real outcomes that we would anticipate were realized when COVID happened, right? When the pandemic arrived in 2020 Q1, there was an effect in that last month of 2020 Q1. Then there was a major impact when the pandemic hit in full force. And then there's been this sort of decline over the next couple of years. And if you accumulate all of these things, of course, it is going to imply a pretty big gap in levels growing for more and less exposed firms. I should say these are in standard deviation units. So one standard deviation change in ZI generates roughly an 18 percentage point change, or an 18 log point difference in revenue growth. And the cool thing is, I'm not sure if you guys think it's cool or not, but these abnormal returns do nothing. Whereas if you look at the regressions that we ran, even in the in-sample regression that might have suffered from overfitting, we're never explaining more than half the variation in these abnormal returns. So there's a lot of variation in these abnormal returns that's just not systematically related to later real outcomes. And the ZI appears to capture any systematic variation that is related to real outcomes. So this basically tells us, it allows us to quantify in this relatively tightly identified way what the impact of pandemic exposure is on real outcomes. All right, so I think I have about 10 more minutes, right, or 15 more minutes. I don't want to go through all of these real outcomes regressions because they all sort of say the same thing. I do want to get into the interpretation, but let me go through. Oh, sorry, you have a question, Luciano?
Yeah, just two things. You have like almost 30 minutes. Yeah?
Okay.
Like 25 minutes. And the other is, sorry for keeping asking this. So just to understand your first graph. So you are saying that before the pandemic, the effect of this variable that is kind of summarizing the risk, the effect of this in the regression, in the returns, in real outcomes is zero. So it's like these risks haven't been materialized. And after the pandemic.
So what we're, so just to be clear on that, and then I'll let you finish your question, sorry.
And I see that after the pandemic, the effect of this set variable is now significant. So I just want to see if the interpretation is that it could be a case that with the pandemic, all these risks materialize and now have an effect.
Yeah, so I'm not reporting in that panel the estimated coefficient in the baseline period. So I do think that this is, I mean, Christian, you can, if Christian is still on the call, he can write into the chat just to confirm or not confirm. I think that this is marginally positively significant. So having a higher Z-score in early 2020 was positively correlated with revenue growth in 2018 and 2019. So firms that were anticipated to do, well after pandemics arrived were already growing faster in the baseline period. What this says is that baseline effect in 2018 and 2019, which in any case is not very big. I think it's like 2 or 3 or something like that compared to these coefficients, which are like 20. What these zeros say then is that any correlation between the Z-score and revenue growth looks no different in 2019 than it did in 2017 and 2018. Then, when the pandemic hits, you get kind of a structural break in the association between variation in the Z-score and revenue growth. And now this thing just becomes very important for explaining firms' revenue growth. Okay. Oh, sorry. So Christian has actually clarified that what I just said was not correct. So in fact, the gamma 1819 is marginally insignificant. I think depending on the specification, it's sometimes significant, sometimes not. But in any case, the point estimate is never bigger than about 2 or 3. Okay. So the point being,
I was asking relative to the baseline. That is.
Yeah, exactly. So we should be clear about what that baseline value is. So thanks. Okay. Well, the COVID literature is vast. And so unsurprisingly, other attempts have been made to generate firm level exposures. So there's a paper by Chiarelli and Gertler, which actually take our original working paper from a year and a half ago and use a kind of scaled version of firm level abnormal returns. All right, so they're kind of using as firm level exposures the raw abnormal returns scaled in some way that I don't quite remember. Then there's been a big debate about work from home and whether work from home allowed firms to absorb the impact of the pandemic shock. And Papanicolaou, however you say this, and Schmidt generated a kind of firm level exposure based on the Dingle and Neiman coding of what firms were and weren't able to support homework. Then I think the most interesting comparison is to a firm level pandemic exposure generated by Tarek Hassan and his co-authors. So I'm not sure whether you've followed the literature on measuring firm level risk exposures, but Tarek and his co-authors have a nice QJE paper, I think a couple of years ago, where they use earnings calls, which are another source of firm level text data, to measure firm level exposures to, in that QJE paper, political risk. Well, he's much more efficient than I am. So whenever he gets an idea, there's like 5 or 10 papers that are all kind of about that thing. And one of the papers he's written, it takes the same idea, but measures pandemic exposure rather than political exposure. So he and his co-authors take earnings calls in 2020 and 2021 and measure the sentiment around COVID that firms express. So there were 2 differences between the Hassan et al. Measure and our measure. One is the source of the text. He uses earnings calls and we use risk factors. And the other is the timing. He uses ex post, after the shock arrives, how does the language look, versus ex ante risk factors written down in the 10Ks. All right, so you can basically stick all of these things in, our exposure and these other 3 exposures. The interesting thing is, the only measure that matters when you put all 4 of these in together is this Z-score. Of course, it's a bit noisier because there's some correlation between all of these things. But in spite of the increased noise, this Z-score is the only thing that seems to capture systematic variation and real outcomes, at least as measured by revenue growth, as opposed to these other things, which are basically 0. Okay. So, Tarek, I don't mean to pick on Tarek. I like Tarek. I like his work. But there's other papers he has that are also related to measuring firm level global shock exposures, like Brexit, for example. And this suggests that if you want to measure firm level exposures to a kind of macro shock, you may get more power and more significance out of using this kind of ex ante rather than ex post characterization of what drives those exposures. All right, there's a couple more kind of real outcomes regressions, but I think I'm going to skip them and just go straight to interpreting the channels that underlie the z-score, which is the other very important thing that I think we do in this paper. You can basically do something similar for annual revenue, employment growth, investment. So the impacts on employment are also very strong and significant and persistent. Investment has a significant effect in 2020, not 2021, but anyway. You can also show that the z-score explains earnings surprises. So one of the criticisms of our panel regression might be that there's no beliefs in there, right? But you can actually go and measure analyst forecasts of firms' earnings and ask to what extent did post-COVID earnings deviate from pre-COVID forecasts. All right, and again, the z-score explains those surprises in post-COVID earnings relative to pre-COVID forecasts, and the abnormal return does nothing once you control for z. So basically, lots of evidence that this pandemic exposure derived from the abnormal returns projection onto text is important for real outcomes and sort of drives out other firm level exposures from these regressions. But what are these? That's the other important thing. Okay, the z-score by itself is just kind of a convex combination, so not convex combination, but a linear combination of 16,000 Poisson regression coefficients. So it's a little bit difficult to interpret. So in the last part of the talk, I want to unpack a little bit what this z-score is, to see if we can learn something about what's driving these real outcomes, which is what we really care about if we're doing economics, right? So basically what I want to do is take the 16,000 or so terms that enter this linear combination to construct Z and unpack them into subcomponents. And hopefully those subcomponents are going to be interpretable. So the basic idea is to consolidate terms together that are semantically related and share a correlation pattern with abnormal returns, right? So there may be a positive correlation between alcohol and abnormal returns, which is something I just showed you. But some firms might say beer, some firms might say whiskey, some firms might say ethanol. All of those terms are kind of talking about the same thing, and all of them have a separate estimated Poisson regression coefficient. So I want to consolidate terms that are semantically similar and are all positive or all negative. And I want to call those kind of specific or targeted exposures. So what algorithm am I going to use to build these targeted exposures? Well, first, I'm going to attain a vector representation of each vocabulary term. So there's something called a word embedding model, which we talked about in our course in September, October, which is basically representing every vocabulary term in a vector space. And the idea is that terms are going to be closer together when they are more semantically related. So the underlying statistical kind of information that's being used is local co-occurrence patterns. So two terms are going to be estimated as more semantically similar when they tend to be surrounded by similar terms. So this word-to-vec model is estimated on the entire 10K corpus, accounting for the order of words. Right? Then I'm going to take the top 1,000 terms, both positive and negative separately, as estimated by the strength of their association with abnormal returns in the Poisson model, and try to organize them together. All right, so I'm going to take the top 1,000 positive Poisson regression terms and look for word triples that seem to relate to a similar exposure, like alcohol, beer, and whiskey. I'm going to take those three words, and then I'm going to add words to that exposure that are sufficiently close in the word embedding space, and that's it. Okay. In case there are terms that are multiply assigned to different of these word triples, I'm going to assign terms to the group with the largest similarity. All right, so this cosine similarity threshold that we set is relatively conservative, right? Which means that not many terms in the vocabulary are sufficiently similar to our seed words that they actually enter these specific exposures. So only about 1,000 terms make up these groups compared to the 16,000 in ZI, all right? So let me give you an example. I'm going to skip through these slides and just give you one example. All right, so I'm gonna stare at the top 1,000 positive Poisson regression coefficients, and I'm gonna manually pick out cloud, software, and IT infrastructure. That's my choice, right? In fact, I think it's Christian's choice. Then I'm gonna populate that list with other terms in 10K files that are semantically similar to it, with this semantic similarity threshold of 0.6 in the vector space. So words like hardware, software application, SaaS, server, cloud service, computing, technology infrastructure, so on and so on, right? All of these terms are entering this specific exposure. And this is just one of them. So we have 15 negative exposures and 15 positive exposures. And in total, across all these exposures, there are 1,000 terms that are put into these 30 different sets, right? And that's many fewer terms than enter the original z-score, which was 16,000. But nevertheless, I can do the following, and this is the second, at least what I called remarkable property. So I'm going to define a firm's exposure to the jth category as basically a subcomponent of Z. So rather than sum over all vocabulary terms, I'm only going to sum over the vocabulary terms contained in that particular term set. So my IT exposure is going to go to those 30 or so terms and only focus on their Poisson regression coefficients and their firm-specific counts. And that's going to give me my firm-specific exposure to that particular category, right? Then I can define a firm's exposure to all of these 30 categories jointly. I'm going to call that Z-targ. And then I have everything else, right? So the Z-score contains 15,000 terms that are not in these targeted exposures. So I'm going to have my targeted exposures at the firm level, and then everything else, okay? This everything else is going to be whatever's left over when I regress everything else on Z-targeted, okay? So I'm not going to say that the Z-targeted contains everything, but I'm going to say that anything that it doesn't contain so there's going to be nothing in what the Z-targeted doesn't contain that adds information above and beyond Z-targeted. And here you go. So just to keep everyone on the same page, we spent some time looking at these plots, right? This was the effect of this pandemic exposure on real outcomes, and then saying that whatever's left over in abnormal returns doesn't matter. This is an analogous chart, but I'm doing something different. I'm saying, let's take the z-score itself and separate it out into this set of, targeted terms that I can interpret, and then other stuff in the z-score that's not correlated with targeted. The entire impact of my z-score on real outcomes comes from variation in these 30 interpretable categories. And this is very powerful, right? Because this tells me that if I want to understand what the impact of pandemic exposure is in the real economy, all I have to do is look at variation in these 30 term sets, which makes sense to a human being, right? I don't have to go look at everything else that I'm not quite sure what it means. All right, so let me take you through one example, and that may be all we have time for. So this is another example of an exposure. I showed you the IT exposure just now. Here's the airline exposure. So Christian chose these three words: air travel, airline, and airport. And then here are the other terms that the algorithm consolidated with air travel, airline, and airport. So now I can look at how does variation in air travel exposure by itself impact real outcomes, controlling for everything else that's in my targeted exposures. So my new exposure vector is going to focus on variation in airline exposure, controlling for everything else that's in those targeted exposures. And you see there's a pretty big impact on firms' revenue growth from being exposed to air travel. And in fact, this thing is not insignificant by the end of the sample. So even 2 years later, variation in your use in air travel language prior to the pandemic is explaining lower revenue growth compared to other firms in the economy. Now, why is this happening? You may say this is happening because it's bad to be in air travel. This next plot is pretty cool, I think. This ranks NAICS 4 industries by their maximally exposed firm to air travel. So maybe it's not surprising that scheduled air transportation contains the firm with maximal exposure to air travel. And you can see there is some like sector specific component to this exposure, right? So all of these red dots are different firms inside the scheduled air transportation according to their air travel exposure. So this is going to contain like United Airlines and Delta Airlines and all these other things. But then you can look across at all these other sectors and find that they contain firms that are highly exposed to air travel. Right? Commercial and industrial machinery and equipment rental and leasing is the NAICS 4 sector that contains the second most maximally exposed firm. Data processing, hosting, related services, and so on. The point being that air travel exposure is widely distributed in the economy, not just for scheduled air transportation. And you can go back to the language in firms 10K filings from where this exposure originally arises to interpret a little bit where these risk exposures are and what they say, okay? So this is the product description for the maximally exposed firm in scheduled air transportation. So this is this ATSG. Okay, so what is ATSG? It leases aircraft and provides airline operations, ground services, aircraft modification and maintenance services, and other support services to the air transportation and logistics industries. So that's what it does, okay? So the interesting thing is the maximally exposed firm to air travel within the scheduled air transportation industry is not even an airline. It's a firm that leases stuff to airlines. So you can already see that there are these kind of complex commercial phenomena that these things pick up, not just I fly airlines. So if you go to the risk factors section of this particular firm's filings in our sample, you find sentences like the actual demand for Boeing 777, 776, blah, 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 may be less than we anticipate. They're writing this in 2019. The point is when the pandemic arrives, this risk gets realized. And so the correlation between that and their abnormal return helps inform their later real outcomes. Okay. What about Booking Holdings? That's a firm highly exposed to air travel and something called other information services. Well, it turns out they operate websites you've probably heard of, Booking.com, Kayak, Priceline, and so on. And their risk factors language contains the sentence, our financial results and prospects are almost entirely dependent upon the sale of travel services. Then there's another corporation, Astronics Corporation, which makes like systems for building airlines. So these are parts suppliers to the airline industry. So all of these are exposed to the air travel industry in various complex ways. And the point is we can go back to their language and try to identify where these exposures come from. Okay. I could do something similar for cloud, but I guess you get the idea. So exposure to IT services also generates significant real outcomes in the wake of the pandemic. And then I can go back and look at which firms in the economy are most exposed to cloud computing. And you can again see that there's sort of rich variation. So there's even some investment services firms that are exposed to cloud computing because they do like robo-advising and things like that. But let me conclude and say, what's this paper about? This paper is about characterizing firm-level exposures to macro shocks. And we're doing that through text, okay? And the text-based exposure that we propose explains abnormal returns on pandemic fallout dates, appears to capture a lot of rich information about later real outcomes, both in terms of explanatory power and interpretability, all right? So I think this paper is done. We just have to go write it up. So when I say next steps, I think what I really mean is next papers. So you can apply this to other shocks, right? I mentioned Brexit. You could also apply it to monetary policy shocks or whatever. I think something exciting would be to link this a little bit more tightly to theoretical mechanisms, right? So there's a large literature, for example, on IO relationships and macro, and trying to go back to some of these, you know, if I go back to these airlines charts, you know, some of these effects are clearly supply chain oriented, right? So this company, Astronics Corporation, that's kind of a pure IO channel. And so there is hope to take these interpretable risk factors and organize them a little bit better to try to isolate the kind of direct versus indirect channels of this macro shock, and to what extent the indirect channels arise from supply chains. I think that's sort of one cool application of this going forward. But I believe with that, I will stop. Should be out of time.